Coeur Mining Inc. (CDE) is currently completing a pivotal strategic transition, moving from a capital-intensive developer to a free cash flow-generating senior precious metals producer. The successful execution of two major organic growth projects, the expanded Rochester operation in Nevada and the integration of the high-grade Las Chispas mine in Mexico, has fundamentally transformed the company's financial and operational profile. This transformation is quantified by the substantial inflection in operating cash flow and rapid balance sheet repair evident in the company's recent reporting. Investment thesis: transition to cash generation. The core thesis is that Coeur is reaching operational maturity at a time when macro commodity dynamics are profoundly favorable. Expected production growth for 2025 is robust, with guidance ranges representing anticipated year-over-year increases of 20% for gold, 380,000 to 440,000 ounces, and 62% for silver, 16.7 to 20.3 million ounces. This significant volume increase is driving exceptional FCF generation, as highlighted by the $188.7 million FCF recorded in the third quarter of 2025. Management's use of this cash flow to aggressively reduce total debt from $605.2 million to $363.5 million over the past year is rapidly de-risking the equity. The market valuation has yet to fully account for this structural shift in cash flow and risk profile, with CDE trading at substantially discounted forward multiples, such as a PE non-GAAP FY2 of 9.93x. The operational execution risk associated with the multi-year construction cycle has largely been neutralized. The resulting balance sheet strength and high-quality, high-volume production platform provide CDE with maximum leverage to the highly bullish forward forecasts for gold, $4,500 per ounce, and silver. Current consensus analyst targets range towards $21.27 per share, supporting the view that significant capital appreciation is forthcoming as the market re-rates the company based on sustainable FCF and earnings. Company overview and strategic posture. Coeur Mining is positioned as a senior precious metals producer with a portfolio predominantly located across North America, including operations in the U.S. and Mexico. The long-term strategy focuses on developing and optimizing large-scale, long-life assets that can deliver predictable, high-volume output. The present investment narrative hinges entirely on the successful realization of two critical organic growth projects, which collectively define the company's improved scale and future cost structure. The first is the expanded Rochester operation in Nevada, a high-volume, long mine-life heap leach facility focused on low-grade silver and gold. The successful ramp-up of this operation is the foundation of the current FCF surge. The second major asset is Las Chispas in Sonora, Mexico, a high-grade underground silver and gold mine acquired in a transaction implying an acquisition value of $1.58 billion based on the closing stock price on February 14, 2025. Las Chispas introduces a stream of high-margin, high-grade ounces that complements Rochester's volume output. Management has provided strong validation of its execution, refining the full-year 2025 production guidance. The refined guidance resulted in a 1% increase in the midpoint of expected full-year gold production, settling at 415,250 ounces, and a 2% decrease in the midpoint of expected full-year silver production, settling at 18.1 million ounces. This high-confidence outlook validates the ongoing operational success at these two key sites and assures investors that the planned year-over-year increases, 20% for gold and 62% for silver, are achievable. Financial Performance Analysis, Q3 2025 Review. The financial results for Q3 2025 provide compelling evidence that Coeur Mining has successfully completed its strategic turnaround, transitioning into a phase of high-margin profitability and capital strength. Earnings, revenue, and margin performance. The company's revenue for Q3 2025 reached $554.6 million, surpassing analyst expectations by 6.32%. This strong top-line performance was underpinned by robust sales volumes, 114,495 ounces of gold and 5.0 million ounces of silver sold, coupled with exceptionally high realized metal prices, $3,148 per ounce for gold and $38.93 per ounce for silver. Despite the underlying strength, the reported adjusted earnings per share (EPS) of $0.23 for Q3 2025 marginally missed the analyst consensus of $0.24, resulting in a 4.17% miss. However, focusing narrowly on this slight miss overlooks the underlying financial momentum. The $0.23 EPS marks a significant 91.7% increase compared to the $0.12 EPS reported in the same quarter last year. Furthermore, the trailing 12 months (TTM) EPS stands at a solid $0.69 as of September 2025. The market's disproportionate reaction to a marginal quarterly estimate variance rather than the overwhelming trend of cash flow growth and volume delivery suggests an opportunity for investors who focus on fundamental, long-term operational success. Cash flow dynamics and capital discipline. The defining feature of CDE's Q3 2025 performance is the massive inflection in cash flow generation. Operating cash flow reached $237.7 million, more than doubling the $111.1 million reported in Q3 2024. This strong operational performance culminated in a free cash flow (FCF) of $188.7 million for the quarter. Crucially, the company has maintained disciplined capital expenditures, CapEx, which remained relatively controlled at $490 million in Q3 2025, compared to $42.0 million in the prior year period. Because the major construction phase of the Rochester expansion is now complete, the controlled CapEx post-ramp-up ensures a maximum conversion of operating profit into FCF. An analysis of operational expenditures reveals emerging efficiencies that are crucial for margin stability. Despite sector-wide inflationary pressures, the materials, parts, and supplies costs per ore ton mined decreased to $4.06 in Q3 2025, down from $4.56 in Q3 2023. The capital investments made over recent years have enabled economies of scale and operational improvements, leading to this lower unit cost. This ability to realize internal efficiencies and mitigate external macroeconomic cost inflation reinforces the structural robustness of the new production profile. Balance sheet and capital allocation. The FCF surge has directly translated into substantial balance sheet improvement. Cash, equivalents, and short-term investments increased dramatically, reaching $266.3 million in Q3 2025, compared to $76.9 million in Q3 2024. Simultaneously, total debt was aggressively reduced to $363.5 million, marking a substantial reduction from the $605.2 million reported in Q3 2024. The year-over-year reduction of nearly $242 million in outstanding debt validates management's commitment to financial conservatism following the capital-intensive expansion cycle. This rapid deleveraging fundamentally improves the financial risk profile of the company, lowering the enterprise risk premium and increasing future financial flexibility for capital returns or accretive growth. Furthermore, management has initiated capital returns to shareholders, completing nearly 10% of its $75 million share repurchase program at an average price of $11.79 per share. This demonstrates management's strong internal conviction regarding the intrinsic value of the stock, leveraging the burgeoning FCF to generate immediate shareholder value. Operational deep dive and reserve analysis. Coeur's operational stability and future potential are rooted in the execution of its primary assets and the underlying quality of its resource base. Production growth and guidance. Execution. The refined full-year 2025 guidance projects a midpoint of 415,250 ounces of gold and 18.1 million ounces of silver. This forecast is built on realized operational milestones. The most critical operational achievement is the successful ramp-up of the expanded Rochester mine in Nevada. The operation successfully completed ramp-up activities at the end of Q2 2025, routinely achieving the targeted daily throughput rate of 88,000 tons per day. This milestone provided the foundational volume necessary to transition the asset to a cash-generating engine. This is financially confirmed by the fact that the Rochester expansion generated $29.6 million in FCF during Q3 2025, a significant improvement from the negative FCF recorded in Q3 2024. The successful commissioning of this high-volume asset mitigates the primary project execution risk that previously weighed heavily on the company's valuation.
Las Chispas and exploration upside. The Las Chispas underground mine is expected to contribute a high volume of quality metal, with prorated 2025 production expected to be 42,500 to 52,500 ounces of gold and 4.25 to 5.25 million ounces of silver. This high-margin asset is critical for enhancing the overall portfolio's grade and profitability. Furthermore, exploration results continue to highlight significant resource upside across the portfolio. Recent drilling at the Las Chispas and Kensington mines yielded bonanza grades in multiple veins. Notably, intercepts at the North Las Chispas vein included exceptionally high-grade mineralization, such as 158 grams per metric ton (GT) gold and 13,430 grams per ton silver. Such high-grade discoveries provide meaningful operational flexibility, allowing the company to blend high-grade material to optimize output quality or selectively mine to maximize margins during potential metal price volatility. This optionality significantly de-risks the asset's mine life and provides robust defense against long-term depletion concerns. The company's reserve base remains robust, providing assurance for long-term production stability. As of year-end 2024, Las Chispas held proven and probable (P&P) reserves totaling 33.5 million ounces of silver and 357,000 ounces of gold. These P&P reserves, along with contributions from Palmarejo and Rochester, ensure operational viability across the forecasted high-growth production period. Macroeconomic environment and price leverage. Coeur Mining's operational maturity aligns perfectly with a highly supportive and structurally bullish macroeconomic environment for precious metals. Structural drivers for precious metals. The current rally in gold and silver prices is driven by powerful, long-term structural factors, not merely cyclical fluctuations.
Geopolitical uncertainty and a weakening long-term outlook for the US dollar provide classic tailwinds. A key distinguishing factor of the current rally is the unprecedented level of central bank purchasing. Since 2022, official sector gold purchases have averaged more than twice their 2015-2019 average, with central banks' share of total demand rising to nearly 25% in 2024. This sustained governmental demand provides a robust structural floor for prices. Reputable financial institutions project aggressive price expansion through the midterm. UBS forecasts a gold price target of $4,500 by 2026. More aggressively, major banks anticipate gold averaging in the high $3,000 through late 2025, with multiple institutions forecasting prices exceeding $5,000 per ounce by 2026. JP Morgan, for example, sees gold averaging $5,505 in Q4 2026. Price gains for precious metals are expected to increase by around 42% in 2025, marking the strongest annual gain since the late 1970s. CDE's exposure to bullish macro scenario core is strategically positioned to maximize returns in this rising price environment. With an average realized gold price of $3,148 an ounce and silver at $38.93 an ounce in Q3 2025, CDE's operational leverage ensures that as prices move towards the consensus 2026 target of $5,505 an ounce, nearly all incremental revenue will flow directly to the EBITDA and FCF lines. The company's decision to commit substantial capital to expand its silver platform, Rochester, aligns perfectly with the consensus expectation that silver is poised to structurally outperform gold due to its dual role as an industrial metal and a store of value. The anticipated 62% year-over-year growth in silver production ensures CDE maximizes its exposure to this dynamic sector, thereby compounding the potential returns on its invested capital and providing a higher relative valuation compared to gold-only focused peers. Furthermore, the resource base contains substantial inherent value that is not fully reflected in current statutory filings. The proven and probable reserves across the portfolio were calculated using conservative metal price decks, e.g. $1,800 to $2,000 per ounce for gold and $23.50 per ounce for silver used for 2024 reserve calculations. The actual realized price in Q3 2025, 3148 AU, 3893 AG, and highly bullish future forecasts automatically increase the theoretical economic cutoff grade and expand the viable economic reserve base. This revaluation effect means the resource inventory is deeply underpriced, providing a material unbooked increase in the company's theoretical net asset value, NAV. Valuation analysis. CDE's current valuation multiples, when compared against its expected growth trajectory and peer group, indicate significant undervaluation. The market has not yet fully discounted the earnings acceleration resulting from the FCF inflection. Relative valuation using earnings multiples analysis. Analysis of forward earnings multiples demonstrates a deep discount relative to peers and CDE's own anticipated earnings growth. Coeur's TTM PE non-GAAP stands at 22.25x. However, the projected earnings growth results in a staggering compression of the forward multiple. PE non-GAAP F1 is 16.73x, and PE non-GAAP FY2 drops to 9.93x. This dramatic contraction from a 22.25x TTM PE to a 9.93x FY2 PE quantitatively affirms the highly leveraged earnings acceleration driven by the operational scale. The market is signaling that earnings are projected to more than double over the next 1 to 2 years as the major capital projects reach sustained profitability. When compared to the general peer average PE of 56.8x or peers like OR 28.28x FY2, CDE is deeply competitive, suggesting substantial room for multiple expansion as the company delivers on its FCF targets. Analyst consensus and target prices. Institutional support for Coeur's growth narrative is strong, reflected in a current consensus rating of strong buy, average rating of 1.3, with 7 strong buy ratings and 3 buy ratings. Recent target price increases point to significant upside, with figures reaching 21.27 and an average 1Y price target of €18, implying a substantial upside of over 41%. Management's execution of the share repurchase program at an average price of $11.79 per share, well below the institutional targets, reinforces the view that the stock is currently trading at a material discount to its long-term intrinsic value. Risk assessment and mitigation strategies. While Coeur Mining has successfully mitigated its primary execution risk, a thorough analysis requires consideration of ongoing geopolitical, operational, and financial risks. Geopolitical and operational risk. Operating mines in Mexico, Las Chispas, Palmarejo, exposes the company to elevated jurisdictional risks, including potential regulatory changes, community challenges, and permitting delays. Coeur mitigates this by maintaining a strategic portfolio balance with robust, high-volume operations located within the lower-risk jurisdictions of the United States, Nevada, and Alaska. The successful completion of the Rochester ramp-up, achieving 88,000 tons per day throughput, removes the largest single operational uncertainty in the medium term. Financial risks. The primary financial risk is the inherent volatility of gold and silver prices. However, the company's recent financial successes provide substantial protection against future price downturns. The aggressive reduction of total debt to $363.5 million reduces fixed financial obligations, making the company less susceptible to severe margin compression if commodity prices dip. Furthermore, the high-grade optionality offered by assets like Las Chispas allows for selective mining strategies to support cash margins even during challenging periods. Cost inflation, particularly related to labor and energy, remains a sector-wide threat. Coeur has demonstrated effective mitigation by realizing scale efficiencies at its expanded operations, leading to decreased unit costs for materials and supplies. The refined cost guidance for 2025, which saw adjustments lower at 3 of the 5 operations, indicates management's confidence in sustaining cost control. The timing of the company's risk reduction is particularly noteworthy. The successful transition to FCF generation and the neutralization of primary operational risk, Rochester ramp-up confirmation, coincided directly with the onset of a historically strong, structurally supported commodity price rally. This synchronized timing reduces the probability that a negative operational event would occur during a commodity price trough, thereby multiplying the beneficial impact of strong pricing on the newly established efficient production base. This confluence of successful operational execution and external tailwinds establishes a low-risk, high-return profile for the investment. Conclusion and investment recommendation. Coeur Mining Inc. is executing its strategic mandate effectively, positioning itself for sustainable FCF generation and exceptional earnings growth. The Q3 2025 financial results mark the definitive inflection point, confirming that years of intensive capital investment have successfully matured into a high-volume, high-margin production platform.
The investment decision is strengthened by three reinforcing factors: operational maturity. Major project execution risk has been resolved, with the Rochester expansion successfully reaching steady state and Las Chispas contributing high-grade, high-margin ounces. Financial deleveraging. Rapid debt reduction and FCF generation have fundamentally improved the balance sheet, significantly lowering financial leverage risk. Macroeconomic alignment. The company's optimized expanded capacity is perfectly timed to capture the exponential margin expansion expected from consensus gold and silver price forecasts, $4,500 plus. The deeply discounted forward valuation multiples, 9.93x FY2 PE, do not yet reflect this positive confluence of factors. Based on the fundamental strength of the balance sheet, validated operational growth, and leveraged exposure to a bullish commodity cycle. Key monitoring metrics should include sustained quarterly FCF generation exceeding $150 million and continuation of the share repurchase program.